from SignalRank. We're going to be learning. Oh, there's Andrew. Good to see you, Andrew. We'll be learning about SignalRank today, which is a super interesting way to invest in secondaries. I've never seen this model before, and as far as I know, Keith and SignalRank are the first folks to do it. Keith, would you like to tell us a bit about you, and then we'll get started on talking about SignalRank, and we'll do a Q&A at the end. Anyone in the group, just drop questions into the chat, and I've had some questions sent through ahead of time as well by folks who couldn't make it.
So Keith Tier, I'm British by birth. I've lived here in Palo Alto since 1997. The reason why is somewhat interesting. I started Europe's first internet service provider in 1994. It was called EasyNet. EasyNet IPO'd. It's probably one of the fastest IPOs in tech history. It IPO'd in early 96, 15 months after we formed the company. By that time, we were the largest subscriber-based internet service provider in Europe. And we went on to be in 29 European countries. B-Sky-B eventually acquired EasyNet. And then it was spun out again, actually, as a business ISP later. So that was a long journey. In 1997, I moved to the United States. I was the ideas guy and the chief technical officer at EasyNet and the co-founder. And, when a British company goes public, it stops innovating, it starts executing. And I was the innovation guy. So I came to the States and I started a company here called Real Names in 1997. By 1999, Real Names was a unicorn as well. EasyNet was at the time. So I had two unicorns in the same year. What Real Names did, for any of you for whom English is not your first language, in 1997, the internet was pretty much in English. What Real Names did is it made it possible to type keywords in any language, including Chinese, Japanese, Korean, Hebrew, Arabic, you name it. And it was a keyword that goes to a web page without you needing to know the URL of the web page. The product was called Internet Keywords. Microsoft built it in the browser. Google built it in the search engine. It was called I'm Feeling Lucky in Google. And by 2002, 2 billion people a quarter were using Real Names to go to a website. It was a huge success. Morgan Stanley filed for our IPO. Mary Meeker, is a well-known analyst, was the analyst on the deal. And I went through a fast-track 3-year lesson in how American venture capital works. And came out the other end and co-founded TechCrunch. If any of you are in tech, you probably go to techcrunch.com. It has more than 100 million readers. It's the publication of record for tech, basically. So I founded that in 2005. We sold it in 2010. And I've been focused on venture capital ever since. And SignalRank is the product of that period since 2010, which is, a long time. It's 14 years. So I've been focused on venture first as an angel investor, and then as a technical product person, looking at venture capital through the eyes of outsiders. When you look at venture capital and you compare it, for example, with the S&P 500, that's what a normal person might do. I looked at it through the eyes of a normal person, and I've discovered a way to turn venture capital into a predictable asset class, very like the S&P 500, but better economics. And that's what SignalRank does. And I'd be happy to talk about that, but that's, by way of introduction, that's me. I have 3 kids here, 23, 21, and 17. And my wife is a very senior person at Crunchbase. So any of you who care about stats and data to do with venture capital, Crunchbase is the place.
Yeah, we've given both TechCrunch and Crunchbase a lot of our money over the last few years. So you're welcome. What I like most about you, Keith, I think, is that you had massive successes back when the internet was like early days, and like unlike a lot of folks who made a pile of money then. Like you've kept on innovating, you kept doing, you kept building, kept creating. Like a lot of those folks just became like talking heads or whatever it is. And
Yeah.
you know, you've not done that. And you know, I think there's a lot to learn from folks like me as I approach a certain generation about like continuing to keep your mind nimble and carry on learning, and like there's always more. There's always more.
Right.
Uh,
Exactly. Well, thank you for saying that. My explanation to myself is I can't wake up in the morning and be excited about what I'm going to do unless it's something new.
yeah, yeah, it's a bit of a curse, isn't it?
It
Okay,
is.
so on to SignalRank. Like I've heard this story once. I'm dying to hear it again because I've got a ton of questions for you once we're through, and I'm sure we'll get some from Andrew and other folks pitching in as well.
I'm going to share my screen. Tell me if it works because I'm not familiar with this environment we're using. Tell me if you can see my screen. Uh, it says Safari, but presenter overlay on screen. I don't think it's working, is it?
Would it help if I can share mine probably? I've got your deck as well.
So I don't want to use the deck. I want to use a live demo.
Okay.
Uh, uh, so if I click screen sharing, it says allow to share screen, and I click that. Entire window in, and then I get a top bar window. Could not access the capture device. Could not start screen sharing. All right, let's use the deck, and we'll use yours.
Okay.
And
Sorry about that.
and I'll start a preamble.
Okay.
Just to describe it. So SignalRank was founded by me in 2020. But before I founded SignalRank, I spent 4 years running a venture fund in London called ADV. And SignalRank is the result of what I learned at ADV. So what is special to SignalRank? Well, the first thing, for those of you who are not native to venture capital, the first thing to understand is that venture capital is not a single asset class. Venture capital is three asset classes, arguably even more, but it's at least three. It's a seed asset class, that is to say, investors who invest very early in companies. Typically, their check sizes are between a few $100,000 and probably no more than 5 million. A venture asset class that typically comes into a company roughly the second or third round of investment. And then a growth asset class that comes in later still and writes very large checks, often up to hundreds of millions of dollars. These three asset classes are totally different. And if you go back to when I founded TechCrunch, there was only one asset class. It was venture capital. So the other two, seed and growth, are new. And the rise of the seed asset class starts around 2007 and coexists with the rise of unicorns. Probably you've all heard of this phrase, unicorns, companies valued over $1 billion privately. And most of the unicorns, today there's well over 1,500 unicorns, grow fast and get big, mainly due to the penetration of mobile phones, because the software that gets distributed gets to billions of people. So those companies grow super fast, whether it's food delivery companies or social media companies, almost anything, music, streaming companies, you name it, they get big fast. And that is unicorns. These seed funds are where unicorns are born. There isn't a single unicorn you'll find that didn't start life being invested in by a seed fund since about 2007. And at the same time, there isn't a single unicorn that didn't become a unicorn because a growth investor wrote a big check to them. So the ecosystem is a kind of continuity belt between the entire journey, if you will, of a company. What SignalRank has discovered is that there's the opportunity to put money into unicorns early. at the seed fund manager stage. We call it's the Series B round that we target before the growth investors come in. But to do that, you need to know the likely future unicorns before they become unicorns. You need to have really two things. You need to have partnerships with seed investors who are already invested in the company. And number two, you need to be able to predict outcomes early in the life of a company. So if we go through the slide deck, you'll start to understand how we do that. We call it systematic venture capital. That word systematic comes from public markets. It basically means automated investing using data. So we're a systematic investment company. We use data. We build algorithms that score companies, and those companies are distinguished from all the other companies in the asset class by virtue of the fact that about 30% of them turn into unicorns. And if you look at the general stats for Series B, it's about 9%. About 9% of Series Bs become unicorns. The companies we score highly due to our algorithms, it's 30%. Scoring a company is only half the battle. Getting money into it is super hard because the high scoring companies are the ones that everybody wants to put money into. And so it's crowded. The demand is far bigger than the supply. So the way that we get money into these companies is we recognize that the seed investors who are already 2 or 3 years into their relationship with that company and its team have strong influence over the founders and the CEO. And typically, because they're already investors, they have the right to continue to invest in the company. It's called pro rata rights or follow-on rights. But because they're seed funds, they don't have the capital at the B round to actually do that. They have the right, but not the capital. So what SignalRank does is we write checks through a special purpose vehicle into those high scoring B rounds using the follow-on rights of our seed partners. And we have over 300 seed partners who are in thousands of companies post the A round, many of which will score highly when the B round comes along. So those partners send us information that this company is doing a B round. We then score the company. And if the score is in the top 15% of B rounds, we'll underwrite an investment into that company. Typically up to 10% of the money raised at the B round can come from prior investors. And we underwrite as much of that 10% as possible and put it into the company. And it's those investments that when you test our algorithms historically will produce roughly 30% unicorns. It's actually 31%.
That's great.
It says here we have 100 seed partners, but this is an old deck. We now have more than 300, by the way.
Things changed.
We started investing in May 2023. It says here we have 7 investments. We actually now have 12 investments. That means that SignalRank is number 4 most prolific B round investor in that period since May 2023. We just closed one yesterday in a company called Beehive. If you do a Google search for Beehive, spelled B-E-E-H-I-I-V, you will see it's a Substack competitor with some very, very top-notch investors, and we are part of that funding round.
Yeah, we got a note from them yesterday saying they raised $23 million. We used to have former players.
There you go. I think it was 33 actually, wasn't it?
Was it?
I think so. Well, 23, 33. So they did a good rate. The goal, as it says at the bottom, is to do 30 B rounds a year. That will make us the number 1 B round investor in the world. So that's kind of a high level. Now, if we go through it, we can do it more quickly now. The next unicorns have already raised a Series A means we're already scoring these companies from their very first funding round. And at the Series A, we can stack rank them according to performance to date. We do that using proprietary algorithms. Maybe in the Q&A, we can talk about how we do that. I won't bore you with it now, but it works. And so our goal is, Series A, you typically have got about 20,000 companies over 4 years. We narrow that down to just over 1,000 companies that are high scoring, likely B round winners. If we go to the next one, how do you get access to these early and at scale? Well, the short answer is you can't, but we can. And so what we do is we sell our shares. And you could think of a SignalRank share a little bit like a share in the S&P 500. When you buy the S&P 500, you're buying an index or a basket of companies. When you buy a SignalRank share, you're also buying a basket of companies. Except in our case, that basket keeps growing month by month. And you own everything we buy going forwards as well as from the past. So you're buying into an index that is itself a growing index. And you do that through buying our shares. It's pretty simple. Next. Now, why do we partner with seed investors? This really tells you the story. That red bar there that says 514 is the number of unicorns picked by the top 200 early stage investors. And that compares, and that means at the seed round or the A round, the investments they made at the seed and A turned into unicorns. On the left, you've got the black and red bars. Those are the top brand investors in Silicon Valley. And that's how many unicorns they got into based on their seed and A round investments in red: 21, 94, and 62. And so what that tells you is most of those funds, they get into unicorns much later when it's already obvious. Our seed investors get in very early when it isn't yet obvious. So by partnering with them and then scoring their investments, and typically it's like 1 out of 20 of their investments become unicorns at that stage, we get access at the B round to future unicorns. That's how we do it. And it's a very good strategy because they're the ones who pick the companies initially. Next slide. They don't have enough money to keep going is in this 1.2 number. This 1.2 is the answer to the question, how many funding rounds do the seed investors do in their best companies? And the answer is 1.2 rounds. So they'll do the seed and they'll do about 20% of the A. Why? Because a seed manager raises money to do seed rounds and doesn't have money to do later rounds. That's the very nature of their business model. So they secure rights to keep investing when they invest at seed, but they don't have the capital to do it, so they don't do it. And there's all kinds of solutions they try to find for that. So you will hear the word opportunity fund bandied around in venture capital. That's when a seed manager tries to raise an extra fund to do the next stage in the life of their companies. Only about 9% of seed funds succeed at raising opportunity funds, so it's super hard. The rest usually scrabble around in the week before a funding round closes, trying to see if anybody wants to invest in it. And they do their own special purpose vehicles, which mostly fail to get done. So this is the opportunity that we see. It's a massive gap in the market to underwrite later round investments from successful early stage seed investors. Next slide. So we're an investment company. This is more of a regulatory fact. In the US, there's something called the Investment Company Act 1940. We are regulated under that act, and we are treated by the SEC as a fund, even though we're a company. So we have to comply with fund rules. That means, from a practical point of view, we're limited to 2,000 investors prior to being registered under the act and being a public company. So we have slots available to participate in the index, only 2,000 of them. The goal of our company over time is to raise $1 billion to put into these rounds to build this index. So if you divide 2,000 by $1 billion, that tells you that you want to be taking no less than $500,000 per bucket. Obviously, some people invest more than that, a lot more in some cases. So we're an investment company, and when you buy our shares, it's like buying a share in, let's say, Berkshire Hathaway, which is also an investment company. Except we're private and they're public. Our goal is to be public. Next slide. We've already explained how we access Series Bs, but it has a name, pro rata as a service. That's how our partners think of it, where we have a service. They're our supplier. They supply us with pro rata. We supply money into their pro rata or their follow-on rights. So they're our suppliers. And you guys, listening to this, you're our customers. Our customers want to turn money into more money. And that's what we do. We basically, our goal is to turn money into more money. We've talked about unicorns, 30%, but I can also tell you that on back tests, the average gain in the first 5 years of a B round investment for the high scoring Bs that we choose is 5 times your money. Now, the S&P 500 says it will do on average 10% a year. We say on average will do 100% a year, although it won't be even, it won't be every year. By year five, the average outcome is 5 times the B round investment. And that happens because those companies go on to do C rounds and D rounds and at higher valuations. Next slide. The market size is very big. If you look at the amount of money raised in B rounds, and you assume that 10% of that money is available to earlier investors as follow-on investments, it's about $1.3 billion a year is our total addressable market. We want to do 30 investments a year, and it's an average of $5 million per investment at peak once we scale. So you're looking at about 150 million out of that 1.3 billion, or let's say in round numbers, 10% of that is the operating market that we're going after. Next. How we do it is through software. It's all automated. If I could have shared my screen, I would have showed you the live data flows on the left here, which automatically selects Series B rounds that we should go into. We have an app that our investors have, by the way, which shows you all the candidates leading up to the B round. So if you yourself are a venture investor, we'll show you the high scoring A rounds. You can use that any way you want, including to do your own investments in those companies. And then on the right, we basically automate the creation of special purpose vehicles, fund them, the SPV is always in the name of our seed partner. It's not in our name. Because that's who the CEO is familiar with. And they then put that money into the company. They manage the company, not us. We're basically a true index. We're a passive investor and a passive index. I've already talked about this, so I'll save our time, but suffice to say, we now have over 300 partners. The demand is probably about 400 million a year. If we had that amount of capital, we could put it to work. And there's no question we found a niche, a big niche, that we've built the right product for. So if you think about us as an index is by definition a horizontal phenomenon. You're across the best. Now our scoring engine is both geographically neutral and sector neutral. We basically just go with the scores. The most likely outcome comes from the scores. And what that means is, in practice, we're spread across all the geographies and sectors that good B rounds are happening in. About 70% of those are in data, AI, SaaS, and software. About 30% are in health tech, biotech, government tech, and climate tech. The geographical spread, about 50% of venture is done in the US, but about 75% of high scoring B rounds are in the US. So we're about 75% US. The rest of the world is the other 25%, made up mainly of Europe and Asia. So and as I said, we're neutral. We follow the scoring, not sector specific or geographically specific. The algorithms I've already talked about. So suffice it to say that in venture capital, you're talking about companies that are super early and where there is no meaningful data that would allow you to distinguish between one company and another. It would be useless to score founders. It would be useless to score traction because there isn't enough of it. It would be useless to score, where they went to university or who they're hiring because they all hire good people. So SignalRank scoring is best thought of as Moneyball for venture capital, where the Moneyball variable is actually the investor, not the company. Every single investor is like a coach in sports, and coaches have track records. Even when they build a new team, the coach has a track record. And it's the same in venture. Even when they invest in a new company, the investor has a track record. So our scoring scores investor track records. And so when 4 investors invest in a company, we bring in 4 track records into our scoring system. And that allows us to measure that company against another company in terms of likely outcomes, because they have a different 4 investors who have different track records. So we base everything on investor scoring. Collective investors in a funding round, that's called a round score. And when a company gets to the B round, typically that's their 3rd or 4th funding round as a company. You add together all the round scores and that gives you a company score. And it's called a company score, but it's actually scoring the company from the perspective of which investors they've attracted. And those investors do due diligence, they're experienced, and so that investor score is a sign of quality. And that's how we do it. Next one. This is just reaffirming the probability of a unicorn. It's actually 31% now. When we did this deck, it was only 29%. We upgrade our algorithms annually. I'm just working on version 3 now. This is from version 1. Let's keep going. We've already started investing. We've talked about that. Next slide. By definition, because we score investors, the rounds we invest in are led by really good investors because they score highly. So the 12 companies we've invested in now, several of them Andreessen Horowitz, which is the A16Z, led by Mark Andreessen and Ben Horowitz, invested in. Accel, which is the #1 best investor in the world in 3 different stages, seed and A and B. Lightspeed Ventures, which is Silicon Valley based, but also very strong in India and China. Lux, USB, you name it. And Y Combinator, of course. So we literally can't invest in a B round unless it has this quality of investor because it wouldn't score high enough. Next slide. Structure. Our structure really speaks to how do you make venture capital successful. And in order to understand that, you need to know how it normally fails. The way venture capital normally fails is 2 ways. One is the venture capitalists pick bad companies or don't have access to good companies, so their portfolio is not good. We deal with that through the algorithm and the relationships that get us the access. The second way that venture capital funds fail is even when they're in good companies, the gains they make are just paper gains. It's called IRR. Sometimes it's called MOIC, multiple of invested capital. Sometimes it's TVPI, total the total value to invested capital. But it's all paper. The only real cash gain is called DPI, which is distributed to paid in capital. And that's when a company exits and you get cash back and you distribute it to your investors. So the primary way of failing in venture, even when you're successful, is not being liquid. I decided really early in the life of SignalRank to be a company that will be listed on the New York Stock Exchange because I don't want to have lack of liquidity for my investors. So instead of asking people to put money into a fund, I've asked them to buy shares in a company. The reason is that I will list that company in New York. My guess is 2027, 2028 would be the window. And, a venture fund normally it's year 13 or 14 that you get liquid. This will be year 5 or 6 for me. Your SignalRank share, which is really just a token to all of the underlying companies we've invested in, can then be sold on the stock exchange to a new buyer. And you can realize the value already in the shares, even though the underlying companies are still private companies. They don't need to exit for you to be liquid. That's why we have this Delaware C Corporation selling shares instead of a fund allowing you to invest in the fund. It means that you will be liquid. The second thing I can do in a company that I can't do in a fund is I can sell early. So when my investments get to 3 or 4 or 5x, I can sell and realize cash in the secondary markets, and I can invest that back into a new batch of Series B rounds. That means I can create a compounding effect. So I can take $1, turn it into 3, take that 3, invest it again and turn it into 9, and take that 9 and invest it again and turn it into 27 over 4 cycles. That it means that we're kind of an evergreen structure as a company listed to give liquidity. So you get the benefits of compounding and the benefits of liquidity. That's the structure that we've decided to go for. And it says we're raising today. In fact, we're raising pretty much every day. The way we work is we sell preferred shares to people like yourselves every 90 days. We take the money realized and invest it in B rounds in the next 90 days, and so on and so on. We have a total of 40 million preferred shares. They're priced at $25 each today. That price will go up as the assets we invest in do subsequent rounds that raise their value. But today it's $25. We started in June. A B round to a C round typically takes 2 years. So I would imagine this $25 share price will be good for another, let's say, 2 or 3 quarters, because we first started investing a year ago. And you can buy as many as you want, when you want, and you can do it over time or do it all up front. And we're open for business selling shares constantly, just like the S&P 500. You can buy an S&P 500 share anytime you want. You can buy a share in the SignalRank index anytime you want. Next. Team-wise, we're small. This is a data-driven automated business. We don't need lots of people. So we're highly profitable. Our gross margins, by the way, after cost of sales are about 85% profit over time. So this is a small company. I'm the founder and CEO. I'm going to pick out Sean Purcell as the next one. Sean was the data science lead at Netflix and at Amazon who built their recommendation engines. And ultimately, SignalRank is a recommendation engine for Series B rounds. Sean is Mr. Recommendation Engine. You can check him out on LinkedIn. Yi Ma works with him. Yi's worked with Sean in one previous company. Yi is Chinese by birth, is a genius by brain, and does a lot of our data stuff. Keivan, to the left of Yi, was the founding chief operating officer at Plug and Play, which is the biggest incubator of startups in the world. And so he's a startup guy here in the Valley. Matt Melkonian is a hedge fund operations guy who runs back office, both legal and accounting for us. He's based on the East Coast. The rest of us are West Coast. And Rob Hodgkinson is a fellow Brit who was a venture capitalist for 15 years, most recently at Beringia, which is a European fund, and before that at Rothschild's Ventures. So that's our team. Next. Investors, for those of you who know about Silicon Valley, this will shock you. This is probably the best group of investors you've ever seen in a startup. Gary Tan is the chief executive officer at Y Combinator. He also built Initialized Capital, which is one of our partners for pro rata investing. Lip-Bu Tan was on the board of SoftBank's Vision Fund and SoftBank, the corporation. He's now on the board of Intel. He runs his own venture fund. He was the founder of Walden International, which is one of the strongest China Silicon Valley crossover funds that do both. He's a very wise and very experienced person. Dan Rose was the head of business development at Facebook for more than 10 years. He's now the chairman of Coatue Ventures. Coatue is one of the largest late stage investors that do growth investing. If you check out Dan on LinkedIn, you'll see he's like an unbelievable record. Blake Grossman was part of the team that invented index funds at Wells Fargo, index funds for public markets. So if you read the book Trillions, which is all about Berkshire Hathaway versus index funds, Blake's name pops up in that book many times. So he's one of the formative thinkers in index funds and was, in his most recent job, vice chairman at BlackRock. And I'm sure you've all heard of BlackRock. Tim Draper has a huge reputation around the world. He was the first investor in Skype, for example, and also Hotmail. He's kind of a billionaire. Tim is a very good friend and an investor in SignalRank. Glenn Catcher, one of the founders at Tiger Global, which is another late stage investor, now runs his own hedge fund in public markets called Light Street Capital. Harris Barton is an American football hero. I've been to his house. He's got 4 Super Bowl rings. He was a 49er. He was the guy that protected Steve Young from getting killed on the field. Vince Cerf is basically the founder of the internet. He invented TCP/IP. And that's just a subset, by the way, of our investors. There's more besides that. So it's a fantastic group of investors. And that is it. That is me. Happy I could do this. Happy you could share your screen. Allow me to do this. And now I'm happy to pause and let's talk.
Yeah, for sure. So that was super helpful. Thank you, Keith. I think I learned more this second time around than I did the first time. Thank you. I've definitely got a bunch of questions. I want to let Andrew, since he's been waiting patiently, pop in with any questions he's got, though, before I jump ahead. Anything you've got, Andrew, just drop it in the chat if you're still if you're not off making a cup of tea or something. All right, well, for now, my first question is, where are the holes in the algorithm? So if it's focusing on people who have fantastic seed round investors, loads of super talented folks haven't got the connections or whatever it is to get in front of them in the first place. Is that a problem, or are there enough fantastic opportunities within the companies that are picked up by the algorithm that it's not a big deal?
So our KPI really is how many of the fantastic opportunities do we see early enough to get into?
Okay.
So there are enough opportunities by far. Like in April, we just saw there were 4 that and we did 1 because that was the one we saw. So as we think of our pipeline, the very top is all Series B rounds. So for example, there were 65 in April. The next is how many of them qualify for our money? And the answer was 4. And then the next one is how many of those do we see and have a partner that we can underwrite? And the answer was 1.
Okay.
Now, so that's our pipeline. So the holes really are all to do with awareness and visibility of B rounds prior to them closing. And Rob Hodgkinson runs that part of our business. And it's very automated. These 300 partners all have a portal. They see their own portfolio in that portal. They can click on a company that has a B round term sheet and send it to us and ask for whether it qualifies. So it's pretty automated and pretty comprehensive.
How helpful is it being married to someone who is senior at Crunchbase when you're getting all this data?
Well, I have to have a deal with Crunchbase CEO. I can't really use my partner's influence there. So we're commercial. By the way, Andrew's asking about the math. It's 40 million, Andrew, not 14, 40.
Okay. Does that answer your question, Andrew? We'll just wait. um,
So that's one whole. There's whenever you're dealing with algorithms, there's a lot to take into account.
yeah.
The first is you're reliant on a back test. So your back test has to be honest and not cheating. Cheating doesn't mean you would purposely cheat, but in data science, it's really easy to accidentally cheat by introducing forward-looking numbers into a backward-looking algorithm. And
Yeah.
so our back test is probably the key piece of technology that we've built. And we can do an instant back test using lots of variables, hundreds of variables, and say, well, if we did it this way, would it improve our results? And it's kind of non-cheating.
Okay.
So that's an area for concern is how solid is our back test. Another one would be the changes in the markets, where the future is not like the past. How do we take that into account? Because obviously the future is never like the past, and you can't rely on a back test to be a direct mirror of what will happen in the future. So our algorithm produces something we call a threshold. And a threshold is a daily calculated line where if you're above that threshold, you're in the top 15%. And if you're below, you're not. And that threshold draws on 90 days worth of data, which means that it adjusts to market changes very fast, really fast. Within a single quarter, the threshold changes. And the threshold determines whether a company qualifies yes or no. And as the market went crazy in 2021, for those who don't know, 2021, the amount of venture capital invested was roughly 3 times more than is normal, measured in hundreds of billions of dollars, and nearly $1 trillion actually. And if we didn't have this threshold, there would have been a lot of, in quotes, good Series B rounds. But the threshold adjusted upwards and made the level of difficulty to be in the top 15% much harder. Andrew's asking, I think you said the ownership is the name of the partner. Does SignalRank hold any ownership directly? So the name of the SPV is in the name of the partner, Andrew, but the ownership of the SPV is 100% SignalRank. So
Right.
we own an SPV in Beehive called RallyCap SPV7. But we own it 100%. It's all of our money. And RallyCap, whose name is on it, their economics are profit share based. We get our money back, and they get to retain 20% of the rest in the case of a profit when that company exits, which is a normal venture capital business model. It's an 80-20 split in our favor after we get the money back. So in fact, it ends up being 85 or 87% comes back to us. And
So they,
13.
so they can't follow on and get the 100% of the upside, but they can get 20% by allocating their rights to you.
Exactly. They get, and that's the same as their fund. The way their core fund works is they raise money from limited partners. They have to produce a profit. If they produce a profit, they get to keep 20% of that profit. So it's exactly the same business model as in normal venture capital.
Right. Makes sense.
Um,
Andrew's got another question there. If
and
you
then
have,
the 2,000 investors. Um, we asked that the minimum number of shares purchased is equal to $1 million investment, but that can be through an SPV. So let's say Alts created an SPV with 50 of you investing. The aggregate investment would need to be $1 million, but each individual could be whatever Alts would say to you. Whereas
yeah,
if you're investing indirectly into us, it has to be $1 million minimum.
right. Andrew's got a question about is there a risk of the SEC allowing an IPO in a fund that invests in early stage companies?
There's always that risk. There has just been an IPO of a company called Destiny.
Mhm.
which you can check it out. The ticker symbol is DXYZ. I think it's on the New York Stock Exchange, but it might be the NASDAQ. It's one of the two. They have net asset value of about $50 million worth of private company stock. They did a direct listing, which means they didn't raise money at the IPO. They just took a private asset and made it publicly tradable, which is what we would do as well. Their first day of trading valued them at $1 billion, even though their net asset value was only 50 million. Yesterday, the last time I looked, it was 170 million. So it's come down, but it's still 4 to 5 times the net asset value. So I think the SEC, as long as you comply with the rules, a publicly traded asset with private assets as its base is allowed. But there's always a risk. I don't want to represent that there's no risk because the SEC could just get, its nose out of joint and decide it doesn't like it. And you do have to get SEC approval for an IPO. The fact they approved Destiny which I do not consider to be a legitimate company at all. I think it's very flaky, a bit like a crypto play that is not trustworthy, which some of them prove to be. So the fact that Destiny could list is probably a good sign for SignalRank because we're much more solid. And by the way, we model out that we'll trade at 3 to 4 times book value when we do list. They're trading at 4 to 5 times book value, so that's another good signal. So I do, but I'm not unconcerned. I think that is a concern. We talk all the time about exchange traded vehicles instead of an IPO. Like it's totally open to us to take the 2023 investments we made and put them into an ETF in 2027 and let them list as a group and realize cash from the buyers of the ETF to invest in the next group. There's lots of mechanisms we could consider. So I think the only thing worth me saying is I'm committed to publicly listing and creating liquidity. The exact specifics, I prefer the New York Stock Exchange with an SEC approval, but for any reason that wasn't going to happen, there's many other ways to think about it.
That makes sense. Thank you. You. So I just want to make it clear, I guess, to everyone who's watching, like there's a deliberate choice being made, I think, when you target Series B rather than Series A or Series C. Can you just explain maybe like why Series
Yeah.
B is the sweet spot?
Yeah. Well, the key problem in this business is access to put capital into the companies. The Series A, most of our partners still have some liquid capability to invest. So they would not be inclined to share their rights at the A round as much as they will at the B. By the B, they're really tapped out. The second is performance. Our A round scoring correlates to unicorns at roughly 15% of the time, which compares to about 5% of the time in the market as a whole. So we're still good at Series A. But there's a lot more losers than winners. And so at Series B, if we invest in 10 companies, we get rid of randomness and it becomes about 80% likely that we'll get our average performance of 30% unicorns and 5 times your money in 5 years at B. If we were to invest at A, the number of investments we'd have to make to get those averages is probably more like 30 investments. I haven't actually done the Monte Carlo to test that, but it'll be a much bigger number. And so by the B, we have access and we have performance that's de-risked and not prone to randomness to the same degree. So the stats engine, can be trusted a lot more.
Okay. And on the other side, you say you're targeting unicorns, which is kind of like by its nature somewhat arbitrary number, right? $1 billion.
Yeah,
If you have 95% hit rate at $900 million valuations, that's absolutely fine, right? Or
yeah,
some unicorns become 50 or 100 billion. Like,
yeah.
do
Well,
you?
I would use slightly different language. I wouldn't say we target unicorns. we use unicorn production as a measure, and it is a somewhat arbitrary measure, just so we have a more populist way of describing the success. But actually, what we target is multiple of invested capital in 5 years.
Okay.
Our goal is to get at least 5 times money average in 5 years. Now, as it turns out, about 30% of those will be unicorns, but a lot of them, 70% won't.
Do you have sort of like histogram data of your picks versus average picks? And like, is it just like shifted to the right basically, or is the
Yeah,
actual shape of the curve different?
it's well, so it's an interesting question. If you look at all Series Bs, all of them, the median outcome is one. That is to say, you don't make money. That's the median. And that median disguises a lot of companies that close down. So in practice, if you're picking individual companies randomly, you lose your money on the median. The average, however, for Series Bs is about 3.6 times your money. So the average and the median are
Very different.
massively different. And the reason for that is that venture capital is a power law business where one or two companies can make a whole year. Even though most companies lose, the one or two pulls the average up to 3.6 times your money and that's 2012 to 2020. That's over a long period. So that's pretty consistent. When we score companies, the ones that score in the top 15%, the median comes up to about 2.27 times your money, and the average to about 5 to 6 times your money. And that's in a 5 year period. If you keep going to all time performance, it's more like 10 times your money. So what we're really doing is we're de-risking by saying no to 85% of the B rounds.
Mm.
And once you disappear 85% of the B rounds, the median comes up and the average comes up.
Of course, yeah.
So the histogram is still power law based. So if you look at any year at our selections, the top 10 will have much better multiple invested capital than the bottom 10. And by the way, in the bottom, some of them will lose money. So it is a histogram. And that's why you have to do a Monte Carlo to estimate how many investments you need to make to get the average. Because if you're just picking any single company we pick, we couldn't stand behind as being a good decision.
Yeah.
But if we pick 10, we can.
Yeah. Okay. Thank you. Andrew's asked another one. How much do you have invested now? How much is currently raised?
So we've raised, we have an interesting structure in that our preferred shareholders own 100% of the business until we've returned a profit to the preferred shareholders. And there's some hurdles there. The first hurdle is that the last money in has a 10% gain, by which time the first money in paying $25 a share will probably have a 4 times gain. So that's the first hurdle. And I own common shares. My common shares are worthless until that last money in is at 10% gain. And then there's a second hurdle where the last money in has to be a 2.5x gain, in which case I can catch up to 30% ownership. So the first hurdle is I can catch up to 20% and 30%. So the market cap of SignalRank today is equal to the money raised. That's the market cap because the money raised owns 100% of the waterfall of the business. The money raised plus a valuation placed on the work we did to build the algorithms and the team. So the money raised is about 12 million. Remember, we only started raising money in June 2023. So that's a year's worth of raise. And the amount deployed into B rounds is about 6 million. We have about 2 million reserved for expenses over the future. So we've got some dry powder. And our goal is that every single quarter we raise more than the quarter before. It's kind of an accelerating raise. If we were a fund, it would be like a rolling close that just every quarter we close some more investors in the fund, except with a difference. Later investors will pay more than early investors as the valuation rises. So the answer to Andrew's question is we've raised about 12 million today. I think it's on our website actually,
Okay.
and it's also in Crunchbase.
Keith, I've kept you for an hour, and I don't want to keep you any longer. I've got a few more questions that I'll follow up with over email, and I'll include in the notes and all the rest of it. But yeah, thank you so much for chatting. We will be taking the recording and including it in a write-up that we do for our audience, both within Altea and then probably a slightly wider one as well. And super excited about this. I think we'll get a lot of positive feedback and a lot of interest.
Thank you, and thank you to Andrew for the questions.
Okay. Nope.
All right.
Thank you so much.
Bye.